Good morning. I would like to welcome you to our next business breakfast, this time on the pricing topic. My name is Maciej Meder, and I'm today accompanied by two colleagues of mine, Marek Kucharski.
Hello, everybody.
Here from the Warsaw office, and Julian Zygmunt from our Frankfurt office.
Good morning.
Good morning. We would like to discuss and present today our experiences on the pricing topic. Of course, during the presentation, which is foreseen for approximately an hour, feel free to ask questions. You can either tap them using the chat function, or you can also use the functionality raise your hand and ask your question, and we will see it and allow you to ask this question. Please also mind that this meeting will be recorded, and we will publish this and make it available after the meeting, also for those who did not manage today, or in case you have to leave earlier, also you will have the possibility to see the full presentation. We have also distributed this morning the presentation with the material which is presented. So if you join via phone, we will also indicate the page number we are currently on. If you have not received this material, please let me know, and after the meeting we will also distribute it to the person if for any case have not received it, if you received it yet. Okay, so now we can go into the pricing topic, and let me also share the presentation shortly. And Marek, before we go deeper into the pricing optimization as such, I would like to ask the question: do we believe that this is the right moment for pricing optimization? If yes, then why?
Definitely it is, and I would like to direct you to slide number 3, where we actually could see the adverse effect of COVID pandemic on banks. So we have an unprecedented situation. Then first we have the combination of negative factors. The first one is, of course, economic recession. The second is already central bank's response with the rate cuts, massive rate cuts. Then we have also the behavioral changes on the client side. We have companies that are postponing investments, and we have also the private individuals that are actually starting to put money aside, lowering the consumption. And all of that, we have also the factor that there's a high level of uncertainty. What will happen actually in autumn and in winter, if we will be hit with another wave of the pandemic, and then it definitely affects and will affect also the companies and banks in the coming months. So this definitely leads, so banks is actually the natural impacted by those factors, since we are serving all clients in companies. And then this leads to the negative effect on the bank income and also on the cost side. So due to the rate cuts, we have the lower net interest income. Due to the lower demand for the credit, we have actually impact on the fee and commission, the impact on the also interest income. And obviously there is another which is related to the uncertainty for the future. We have actually the massive upside of loan loss provision that banks are putting aside, and analyst reports that this loan loss provisions are double in 2020 and stay with us at the same level in 2021. So that let's see the hard times are coming.
But let me be a bit provocative, because if we actually look on the results which are currently available, so for the banks until May this year, if we look on page 4, actually if we look on the net interest income drop, of course we see some movement, but still I would say it's not yet so dramatic like, for instance, already increase in the risk costs.
True. However, we need to have one caveat here, that still the second rate cut is not reflected in the
third one.
Yeah, in the third one, in the year-to-date figures. And we are actually expecting in the coming days the bank results for the June, published by the central bank, and then we could see the full impact. However, as we could see, for example, on the stock exchange, when we have the valuations of the banks, that are actually halved. No, this is also reflecting the potential half return on expected for the year 2020, and let's see what will be the impact of the recovery coming months and also the start of the 2021.
Okay, but of course we have many pricing, and on next pages we would like to discuss, I would say, actually what is possible now on both on the revenue. Of course, also I think banks announce, and this is no surprise, of some movements on the cost side. Why I would say now pricing, and of course which of the price initiatives we believe, I would say, discussing today.
Actually, it is actually the mark for most of the banks that we were in contact during in the course of March and April, when this pandemic was hit, that the first move was actually to, let's say, we need to revise the strategy. No? So all banks were sitting and then thinking, okay, what could be the COVID impact on our operations or the revenues cost side, and also on the operations, because the first focus was actually to ensure that the processes, internal and external processes, are actually working in the remote mode. However, when we see first outline the ones that are related to the revenue side, and we have the ones that are related to the cost side. So banks, after the strategic review, were actually undertaking some structural interventions. No, and on the revenue side, of course, the other more long term with the product extension or the higher market penetration, we see some banks really skyrocketing in terms of the sales. For example, mortgage sales for sales of mortgages. The new players are coming with when they increase market share. And of course, on the cost side, everybody was thinking of the branch cost optimization, operational excellence of the processes, which is actually the hot topic at the moment. And the other ones are actually more long term. However, what we see, and then we did the simulation of the impact of the different components, either the cost components or the volumes components or the margin components, we see that the biggest and impact in the short time frame or short to medium time frame is actually with the repricing. So with the margin increase by 10%, actually we could impact the return on equity positively by the 60%, not the percentage points, okay? So moving to the actually next slide, when we see the potential from the repricing levels, which is the slide number 6, we listed them with the split on the retail segment and the corporate segment. We see that some of them already happened. No, so natural first move was by the banks to actually cut deposit and saving accounts rates close to zero, almost zero. It's somehow funny to see some price lists that are listed on the websites of the banks to see 0.000 deposit rates for all the maturity. And so this is
close to zero.
Close to zero. So this was the first move. The second move that we saw already when we analyzed the price list of the banks is that many banks started to put this clause that they could start charging, especially the medium corporates and big corporates, for excess liquidity. So this is another defensive measure. However, this was only the clause. So let's see how many banks were actually if they will do it in reality. Obviously, one of the most appealing from this measures, from these levers that we listed here, the pricing levers, is the providing the list price for the private individuals, no? Because the market is very huge. However, this could impose some regulatory risk, some reputational risk, and typically the first player that will do it could be hit by the outflow of the clients, especially the ones that are more, let's say, tech savvy, because now switching the account is pretty easy. And that's why measuring the pricing levels based on the potential impact and also on the complexity, implementation, feasibility, then we pre-selected two. One from the retail area, which is with the increase of the margins on the mortgage loans, because we see that the mortgage actually were the least hit by the pandemic impact on the demand for loans. And the second was actually the revision of the individual conditions that are granted to the SME and the corporates, because also based on our project experience and discussion with the banks, it seems that the majority of the corporate clients and the SME clients are enjoying individual conditions, and only a few actually enjoying or not enjoying the standard price list. So these are the two measures that we say, and in repricing we trust, and these are the two measures that we'd like to discuss with you deeper in the next section of the webinar.
Okay, so maybe let's start with the second one, which I believe is very interesting. So adjustment of individual conditions in SME and corporate banking. Julian, this is actually the first case study which we wanted to present today. Can you please elaborate a bit on the initial situation of the client? What was the challenge, and how we identified so-called pricing leakage?
Sure, my pleasure. Good morning. So let's talk a little about case studies from European banks. As you know, these are banks from the, let's say, Central European region in the euro area, and the low or zero negative interest environment that banks are currently facing in Poland. It is something that banks have to deal with already for quite a while in Europe, for example, in Germany, in France, and Italy. And setting the deposit rates to zero was also a very first lever, but now we want to talk about levers that go a little beyond this measure and show you what happened to a good extent when it comes, for example, to setting appropriate individual prices for corporate clients. If we have a look at the next slide, which would be slide number 8, we were contacted by one of our clients who supposedly had a large share of clients who were deviating from standard prices, and therefore relationship managers inside the bank expected the bank to have a very high share or degree of price leakage. So according to the relationship managers, many clients were not paying standard tariffs. However, the bank itself, they didn't have any transparency or any, let's say, clue to which degree this price leakage was actually happening. And therefore they asked us and approached us to, let's say, create some transparency in the first hand, and in the second step to create a concept that would help them to significantly reduce price leakage. So what we were interested about, that is the right-hand side of the slide, is whether there was indeed a relation between, on the one hand, the number of transactions, which would have been displayed on the x-axis, and on the other hand, the price per transaction, because you would expect from a business perspective that the more transactions a client brings you and wants to process with you at the bank, that the lower his price becomes. And whether this relationship was actually happening, we will tell you on the next slide, number 9.
Should be there.
Yeah, now it's visible. So what did we do? At the first step, we set up an individual database on an individual client level, and we were interested in prices and user behavior for cash and settlement services. An example, the current accounts. As you can see on the right-hand slide, on the right-hand side of the slide, the graph now is without a question mark, but it shows actual price dispersion and the distribution of individual tariffs inside the client portfolio. How do you read this? On the x-axis, once again, we have the number of transactions in thousands. On the y-axis, we have the price per transaction. Each gray dot here would represent the price of a single client and the respective number of transactions that he carried out over the last year. So there would be clients, for example, let's take a dot in the lower part of the graph and in the left side that have something like 10,000 transactions per year and pay a list price or no standard or individual price of 5 cents per transactions. On the other hand, there would be clients who process 1 million or 10 million transactions per year, and they pay an even higher price compared to those clients. So what we are saying in the end, that we basically derived a benchmark figure, that would be the red line, where we internally agreed in the project that this would be an appropriate price dependent on the number of transactions that a client is carrying out. And as you can see, many of the gray dots that are represented in this graph are lying below this red line. So there would have been quite some potential compared to what we measured in other banks, compared to also what other clients are paying with the bank to increase prices, at least to a certain extent. I would need to further say that price leakage, as we define it within our project, is the difference between a standard or target price and an actually enforced price. So many clients who might have already agreed upon or negotiated their prices a couple of years ago will still profit from very low prices. And that is something that banks, from our experience, can get rid of by increasing prices, at least to a certain extent, and by introducing a concept that allows relationship managers and the sales force to agree on clients with adequate to agree with clients on adequate prices.
So what was actually the solution approach towards this topic? Because I think everybody is aware about the large share of individual tariffs, but the key question is how to approach it, how to equip the relationship managers with adequate tools to be able really to negotiate with the clients and push certain price levels through.
Yeah, it's very true. The first question that we saved, if we have a look at number 10, is, yeah, people or colleagues approach us and said, of course, but the price leakage does not always have to be linked to the number of transactions. There are many things and points that you can take into account when agreeing upon individual prices. And so as a first step, we introduced a further analysis. What we wanted to know is whether low or individual prices are attributed or agreed upon with clients who have high potential to further increase the business relationship with the bank. So we grouped clients into 4 categories. As you can see at the matrix on slide 10 in the middle, there are 2 dimensions once again. On the y-axis, we have client potential, and on the x-axis, we have current earnings of the client. And what we stipulate at the ZDB projects or overall is that if you agree upon discounts, you should provide discounts to clients who show high potential to further increase the business relationship, because in that case, in return for the discount, they can provide you with further business. What we then did is to see how the current share of discounts was distributed over 4 client types: target clients and clients with high potential. Those would be the ones with overall high potential in the business relationship, just received roughly more than 50% of the discounts. And then more than 40% of the discounts were still attributed to standard clients and clients with a strong relationship. However, those are 2 client clusters that do not show large potentials to improve the business relationship in the future. And these are clients that, from our perspective, should receive a proportion of discounts of maximum 10, 15%, but 40% was definitely too much. So we didn't find or encounter any systematic underlying scheme to provide discounts here. And that indeed left us with the question, Maciek, whether we want to introduce a tool or whether we want to introduce a concept that, let's say creates some order and some underlying systematic when it comes to the distribution of discounts. What did we do? On the one hand, we set up a client-centric discount competency scheme. This implies that on the one hand, we considered factors and KPIs that were linked to the product itself, for example, cash and settlement services or current accounts. We took into account the number of transactions that the client carried out, or the generated fees that he produced over a year in the current account for the bank. So these were KPIs that were clearly linked to the cash and settlement services. On the other hand, it's always possible to also take other factors into account, for example, the industry or the region, also the length of the client relationship, for example, so that you consider basically the holistic client relationship and not only the usage of a certain or given product. And within this concept, we managed to agree with the relationship managers and the sales force which prices and also which discounts would have been appropriate for certain individual clients. However, this is rather, let's say, complex and hard to realize if you don't have any support. So what we did as a second step is we developed an IT tool to support relationship managers that is described on the right-hand side of the slide, upper right-hand slide. This tool contained all the information about individual clients, and relationship managers were able to access user behavior of clients, current price levels, and they were also able to determine adequate prices in a sense that they would know, based on a certain user behavior, based on certain client attributes, which price from a project perspective would be appropriate and adequate, and also which was the internal benchmark, which was identified internally within the ZDB project. So not only the concept, but also the equipment for the relationship manager was important. Then as a third step, we launched training concepts and trainings for the entire sales force. Because from our experience, it's very important to motivate relationship managers and to give them some input in how to effectively negotiate prices with clients. Because if you basically had your last training 5 or 10 years ago and you are not really sure how to enforce adequate prices anymore, this is something that helped a lot, and we received very positive feedback because everyone was very motivated to agree upon higher prices afterwards. And in the end, the last part, which we estimate to be something very important as well, is an adequate reporting format and cycle, in the sense that every superior received a report where he could see which relationship managers were doing a very good job and enforcing higher prices with clients, and whether also some relationship managers maybe still had issues or troubles with negotiating better prices and were left behind. So we could support these relationship managers even further, have separate training sessions and talk with them how to approach certain clients so that no one was left behind. And we had the full transparency whether the initiative was working indeed or whether there were some colleagues who basically were focusing on other aspects.
Jürgen, before we move on, we have one question here regarding the previous slide. Actually, also one of the elements which is used for probably for this discount competencies. So the high potential clients. Yeah. I'll come back to this page 10. The question is, what do we mean by high potential clients? Are these clients with small wallet share of wallet?
Exactly. So these would be clients who currently generate basically few earnings with your bank. So let's say it's a large client, but only 10% of the wallet is with your bank. And in this respect, you could further increase the wallet by 20 or 30 percentage points because indeed he shows low share of wallet covered and therefore high potential.
And we can determine this wallet share either individually or, I mean, sometimes we use some kind of internal benchmarking exercise where we compare this client with comparable clients, I mean, in the same industry, in same revenue type, in the same, I would say, import-export activity, and then we just benchmark if this is, I would say, above, I would say, the average which we have in this cluster or below, right?
Indeed, we have an internal benchmarking scheme. However, what we also frequently do is apply a ZEB benchmark or wallet model, where we use external data that is publicly available to identify share of wallets for certain client segments. And this would then be enhanced by, for example, data about the balance sheet to create further transparency. But indeed, it's possible to do it either internal or on external data.
Because in some aspects, also when we were doing similar exercises in the projects in the banks, we based on the internal benchmarking, will be able even to identify clients which, based on the benchmarking to their peers, it seems that they have a high potential, though they might not have, for example, the certain products in any of the bank, no? Because it might be that the mother company is actually financing this this client, and then it's not visible in the banking sector. No? So in such cases, we also consider, and then we are able to pick up, or even we can identify the client, which is also the case, that doesn't know that have a potential to expand, no, should have the credit but don't have, no. But these are the, let's say, individual cases, and then typically when we start run such assignments, we also identify such outliers.
Okay, good. So we said, okay, we have to focus on the right clients, and we have to, I would say, build client-centric discount competences. We have to support relationship managers with adequate tools, training, and of course also reporting to the sales management that is aware if what we assumed is really happening. Question is, was it really successful? I mean, what effects were achieved in this particular exercise, you know?
Good question. I'm happy to show you the results on page number 12. First of all, of course, I have to mention that this took a certain amount of time. So we measured effects 1 year after we implemented the project. What we saw is that indeed individual tariffs after we launched the new concept were granted based on objective and adequate KPIs. That also meant that capacities that were needed inside the bank to internally align lots of discounts with superiors were significantly reduced. Secondly, within 1 year, 50% of the clients with significant price leakage have been approached. and the relationship managers have successfully renegotiated the discounts. This did not always mean that the discount was reduced completely. However, the price was brought to a more adequate or higher level. And in the end, this led to 20% reduction or reduction of 20 percentage points of price leakage. And the corresponding top line increase that we achieved was more than 30% within 1 year, just from the reduction of individual tariffs and bringing the prices to a more adequate or higher level.
Actually, here maybe because based on also our experience when talking with the banks or the project experience, it seems that when dealing with these individual conditions, we have the situation that many customers in the banks have, let's say, individual conditions for life, no? Because some banks are also the results of the mergers after mergers, and then there were different price schemes in each, especially the challenging banks. Challengers were actually granted such conditions. Question: was it somehow similar to your experience in Germany, Italy, and France? And was there any? What was the strategy toward those customers? You know, how to deal with them, how to negotiate with them? No?
Indeed, we see that there are two kinds of clients. One kind or type is the one you mentioned, clients who already benefited from individual or reduced tariffs for 5, 10, 20 years. And in our experience, it's very well possible to also approach these clients to renegotiate, because it has never been stipulated in any sort of contract that this is a tariff or a price that would have been valid for the whole life of the relationship. And if we employ an adequate training concept and we are able to negotiate with the client in a reasonable environment, from our experience, the clients very well understand that the cost of banking are currently increasing, since many other aspects, for example, the deposits and the whole interest rate environment doesn't generate significant margins for banks anymore. And therefore, we have received very good feedback also on talks with those clients. If the relationship manager is able to provide transparency, and also, and this could also be a case, it's not always necessary to basically reduce or reduce the discount or agree upon a high price. You could also say, okay, we can stay with this price, dear client. However, what we would expect is that you bring 20, 30% of further business volume in order for us to be able to keep this price. And that is also something that helps. So we didn't always think into the direction of reducing discounts or increasing prices. There's also a volume effect that you can consider. And by agreeing on prices by agreeing with clients on increasing volumes and keeping underlying prices, it's also a very effective scheme to basically receive a positive result out of this price negotiation discussion.
And maybe because obviously you said the soft factors, the negotiation skills, potentially equipment of the relationship manager with all the profit and loss of the relationship to potentially have the arguments in terms of the discussion with the client. However, in terms of the structuring of this model of the negotiation of the deals, was in your experience also the fact that we have, for example, not only the relationship managers that are, let's say, approaching the clients in terms of the renegotiation, but also we have, I don't know, special force team that is really skilled in negotiation, getting hard cases, for example, with the slight conditions, but putting contract carved in stone, and then maybe even threatening the customer, okay, we are going to break the relationship with you, close all the contracts and go away, no? So
of course, it would be interesting to try this approach. However, what we value a lot, also what we receive as feedback from our clients, is that the banking relationship with their clients is #1 priority. And what we do not want to damage with such a project is the valuable relationship with clients. So we never ever threaten the client basically with closing the relationship. There are some clients who are, let's say, very stubborn or very persistent when it comes to negotiating prices. And this concept, and that is also something we can say, we will never receive a 100% success rate at all of our clients. Sure. However, we also perceived a very, let's say, high risk when it comes to being too aggressive towards clients, in the sense that they say, okay, now we close our relationship completely. Now we don't do any further loan business volumes with you and so on. And therefore, what helps a lot, Marek, is that we have special teams who really train individual relationship managers on how to effectively negotiate prices and how to negotiate prices in the sense that the negotiation tactics is targeted or tailored towards the individual client, because there are different types of clients. Some are more relationship focused, others more price focused, some are more, let's say, introverts, others are more extroverted. And this is very important to consider, and to have a specialist who can take these factors into account and give dedicated advice is very helpful. However, our advice is usually or always not to threaten the relationship as such, because what we want to have is a, let's say, trustful and ongoing relationship with the client, and therefore our supporting methods and projects underline and support this way of thought, in a sense that we basically value the relationship with our clients as well.
So I could imagine, even when you consider such example as banks are segmenting the customer based on the characteristics, like little customers, and then price sensitivity, whatever. Then you have the dashboard of the different types of the negotiators on the client side, and then you adjust the negotiation strategy towards these profiles. Now, but I think what you described is one, let's say, side of the story, which is the client side, how to convince the client. And I think also when we typically deal with any changes that are affecting the sales force, then we need to also get the buy-in from the sales force. No? So the question is how you cope with the convincing sales force that actually repricing is a must, and potentially if they were somehow motivated by some financial or non-financial factors to basically undertake this challenge and then renegotiate the prices with the customers.
Yeah, that's a good question indeed, because the best concept won't work if you do not have buy-in from the sales force. So what we did is, at the first step, once we developed all the discount setting schemes and the adequate prices, we always made sure to incorporate representatives from the sales force into the project, so that they from the first place when we started the project had a say in the direction that the project was taking. And as a second step, indeed, when we underwent all the training mechanisms and facilities, it helped a lot for us that every relationship manager was part of a training initiative, and everyone was aware that this is a very important factor and topic for the bank. And as a third point, it is also an idea, or it's also feasible to link the incentive system of the relationship manager with a KPI that is linked to, let's say, reduction of price leakage. In this project, however, we didn't do it. It worked out very well because superiors were very much focused through the reporting mechanisms that we provided, that the relationship managers were doing a good job. However, if that is not the case, it's also recommendable to at least think about combining the incentive system of the relationship manager with a KPI that is measurable in a sense of number of talks or the number of cases where the relationship manager successfully reduced the degree of price leakage.
Mm-hmm. We have here your next question, which goes in the direction whether we really in this project need to meet all the customers and renegotiate, or and the question is, what was the success ratio of these negotiations? I understand the background of this question, that maybe in some cases you would like to approach the client and shift him towards, I would say, some kind of a standard price list or certain package, which is applied, I would say, to other customers. So the question is, if we negotiated with all, let's say, if the relationship managers negotiated with all clients, or this was some kind of a sample, or I mean, it was some kind of a mixed approach. Yeah.
Indeed, within the first year, we had roughly 50% of the clients who were approached, not always exclusively regarding the price leakage topic. So there are yearly talks with clients where you could also mention this topic, but we talked with roughly 50% of the clients, also due to the fact that most likely other clients, let's say the other or remaining 50%, only showed very limited potential or no potential at all to increase prices, because not everyone was having a reduced fee. And usually what we do within projects that we prioritize to a certain extent which clients need to be approached first, also in terms of capacity restrictions that we usually face. We know that relationship managers have many things to do, and there are also other products compared to cash and settlement services. However, it strongly depends on the initial situation of the bank. So if only 20 or 30% of clients benefit from discounted rates, of course, it's easier compared to initial situations where we see that almost 70 or 80% of clients deviate negatively from standard rates.
Okay, so I think here about, I'll say, corporate case study and this individual pricing topic. I think we will stop here for the sake of time, just to continue with the second case study which we prepared for today, which is actually, I'll say, from the retail area and deals with mortgage lending. However, I believe that I think this approach in general, which we applied, can be also implemented in, I'll say, for instance, corporate lending as such. I know that we did it also in other projects. But let's move to towards let's say mortgage lending, which of course it's not it's neither in Poland nor in Germany somehow a high margin business, and I think a lot of banks struggle with the profitability of mortgage lending portfolios. Can you maybe also indicate here what was the starting position? What were the challenges in this particular project?
And maybe just for this technical thing, okay, if you could still ask questions for the first part, you could list your questions in the chat, then we will have some time after this mortgage session to basically then revise all and discuss all the questions that pop up until the let's say 9:55, right?
Okay.
Yeah, sure. No, what we found, we had a very interesting project at a large German universal bank that was represented all over Germany. And they were facing one issue or one big question. When it comes to mortgage pricing, as you know, not only in Poland, but also in Germany or all over Europe, margins are very tight currently. So there is not much to gain. And the current pricing models or pricing grids at this bank, they basically stipulated one certain target price for a client. In this example, on the right-hand side of slide number 14, you could see that, for example, a certain client would have been approached with a target price of 1.24%, independent of many factors or willingness to pay that this client would basically have or could have been described with. On the right-hand side, regarding or opposed to this current target price of 1.24%, you see that there would have been different clients. For example, client number 1, client with an individual willingness to pay of 1.48%, and client number 2 with an individual willingness to pay of 1.04%. So what happens now if those two clients are presented with a price of 1.24%? Long story short, client number 1 would say, I happily take it. He would have also accepted 24 basis points of a higher price. So you basically lost a margin of 24 basis points. And the client number 2, he would have never accepted this price. He would have been only willing to pay a lower price, and therefore you lost the deal completely. And our goal and the initiative within the project was to better address and skim individual willingness to pay of individual clients. And that was the target picture and the ambition level that the bank proposed. And now I want to show you how we approach this.
But maybe before that, I have this one anecdote, no? Because this is really, really true in the real life. Because 2 years ago, I was approached by the friend of mine that they were building some private dual, let's say, real estate property. They were building some property, you know. And since they live in the smaller town, no, the natural was to ask the cooperative bank, no, that is basically in that little town, for the offer, no. And the first offer was still the WIBOR was 1.79, but the first offer was 8%, no, for the mortgage, no. And then Marek, tell me, what do you think about this 8%? I said, what? No, I said, I call my friends, no. So I called one in the PKO SA, no, thank you very much. And then the offer from this bank was 4.6, no? So you could imagine that if there was no, let's say, consultation, consultation with me or with the person that in the other banks, or even the comparison on the internet of the prices, no, this customer could even pay 7.5, no, but still will never go down to 4.5, no. So this is actually the very true case, no.
The question, of course, is how to deal with that on the, I'll say, on the portfolio level, right?
Yeah.
I mean, Of course, we can try to determine it for each client, but I would say if you look on the portfolio, how did you approach this issue?
Indeed, on slide number 15, we set up once again an individual client database, and we analyze as a first step so-called net margin drivers. So as you can see in the middle of this slide, there are many net margin drivers from refinancing rate, the cost of risk, whether the household income, the loan volume, and so on. In the end, you can cluster them to basically two categories. On the one hand, from private mortgage financing, those are net margin drivers that belong to the product. So everything that is used basically to set up the product, like the duration, the volume, or also the repayment schedule. And on the other hand, those are aspects and net margin drivers related to the client, like, for example, the household income or the number of children he has, whether he is employed, which zip code area he lives in, and so on. And we looked at each and every of these margin drivers for 3 different mortgage financing brands our client had. And here, for example, we looked at the financing ratio. So financing ratio means the amount of basically debt you need to finance the mortgage. In that example, let's look at the brand number 2. There are many cases that have a debt financing ratio of little more than 100, roughly 110%, implying that, at least in Germany it's the case, the client can buy a house for, let's say, 200,000 euros, but he can still take a loan of 240,000 euros because he would need some additional money to buy furniture, to basically pay taxes and so on. So you can take more money out of the bank compared to the worth of the real estate. And we checked the relationship between basically net margin and all of these net margin drivers here, and saw that indeed many clients were once again lying below a certain benchmark or below a certain average or regression that is here represented as a red line. And those relationships between net margin and certain net margin drivers were very different for the 3 different brands. And for many clients on an individual client level, let us identify at least a certain willingness to pay for certain aspects in order to further elaborate on the pricing grid to make sure that all of these net margin drivers are adequately reflected. Because in the end, it's important that you know for which kind of, let's say, product parameters or client parameters a client has willingness to pay, and you're able to generate higher net margins. And on the other hand, where you should maybe also sometimes reduce your price because the data shows that clients compared to other banks are not really willing to pay such a high price for a certain parameter. Maybe it's the zip code area, or maybe it's also the loan volume or the household income.
I mean, this is more outside the internal view. Have you also somehow compared these rates to the competition?
Indeed, that's a very important second step. So on slide number 16, you can see that for private mortgage financing areas, it's rather easy to construct a benchmark and to construct a competitive analysis. So what we see here on the right-hand side of the slide is our client, which we anonymized here, is the blue, let's say, blue house with 3 pillars. And we compared different user types that we set up towards competition. So as you can see, the first 2 user types, they have a financing duration of 5 years, and the first one a financing ratio of 60%, and the second one a financing ratio of 80%. They are somewhere in the middle or stuck in the middle compared to other competitors. So some banks were way cheaper, others were way more expensive. And as you know, it's also the case in Poland, as it is in Germany, all over Europe. Intermediaries and platforms, they have gained lots of importance over the last years. And it's very important, especially in such a transparent business as private mortgage financing, if you are compared with other banks, that you do not need to be the cheapest one, but you should be somewhere among the top 3 or top 5 players. And this was, to a certain extent, at least the case for the first 2 user types. But now the interesting user type was the third user type. You can see here the duration of 5 years and a financing ratio of 100%. And for these cases, the current pricing grid basically allowed us to set a price of 1.20%, which was 23 basis points cheaper than the next or second most expensive, cheapest provider, ING. And therefore, we could very well tell, or we were very well able to tell that our client was most likely generating very, very many deals for this kind of user type. However, the margin that could have been achieved basically would have been 23 basis points higher, because you do not need to offer such a low rate if the second most cheapest basically provider is positioned 23 basis points higher in terms of prices. And that led basically that gave us very strong and very solid implications how to combine the analysis that we did on internal data in the first place with the external and competitive environment in order to derive a price grid that considered both factors.
Here may be one explanation regarding the duration, because of course here this is example from the German market, which is very much fixed interest rate driven, not like floating rate like Poland. So here with 5 years, we are meaning the fixed interest rate period, and not the, I would say, the total duration of the I would say mortgage, which probably I would say would be longer, but this is the fixing period, right?
Yeah, very right. The Germans are very focused on having certainty regarding their, let's say, repayment schedules, and therefore they frequently fix interest rates to 5 years, 10 years, sometimes up to 20 or even 30 years. So that's a specificity of the, let's say, German market, but I'm very certain that for any other market, basically this duration could be replaced with other figures that drive the willingness to pay.
Okay, so then equipped with this knowledge, I mean, we looked on the portfolio level. I mean, what are the revenue drivers? We benchmarked this with the competition. What was the next step? What was the solution approach?
Indeed, as you can see on slide number 17, what we did is we developed a new price grid that took 3 main important factors into account. On the one hand, the low general interest rate environment in general, which we are facing in Germany for quite a while now. On the other hand, the net margin drivers that we identified due to the analysis of our client portfolio. And as a third step, also the level of competitive prices and whether we needed to adjust certain price levels based on what other competitors were offering. And indeed, this price grid then was way more effective in, on the one hand, addressing clients' individual willingness to pay. Not 100%, that is not possible because we would have needed to apply some magic, but way better than it was the place before. And as a second step, we were way better aligned with prices that were provided by competitors, in the sense that we were not cutting out our competitors' rate by 20 basis points and were able to offer way cheaper prices. And on the other hand, we also had transparency where we were currently setting prices that were too high and we were losing deals. And what is even more interesting now, if we have a look at slide number 18, is what came out of this.
Exactly.
So
what's my next question?
And indeed, as I said, the individual willingness to pay from a client was now way better reflected in the bank's target prices. And that helped, on the one hand, to, on average, increase the margin that was generated with new business for mortgage financing by 15 basis points, so which is quite a lot. And on the other hand, we didn't experience any negative effects in underlying developments of volumes. So the volumes kept stable and the overall margin was improved by 15 basis points on average.
I think here worth asking is actually the channels, no? Because in mortgages now we also expect that more and more mortgages will be sold via platforms, or even now there is a very high share of the mortgages that are being sold by intermediaries, and especially when there's a new customer, no? Because obviously for the current customer base, not typically the bank would be the first natural choice to be selected when let's say asking for the mortgage offer. And while for the new customers that are typically going to the intermediary, they could see several offers and compare. And obviously the intermediary has a lot of, let's say, the power in convincing the client to one offer or the other. How basically this would impact the exercise that we are actually here proposing?
Yeah, indeed, there are the the topic of intermediaries is rather, let's say, I don't want to say difficult, but complex to approach, because on the one hand, those intermediaries create a very nice transparency for clients. So you can really compare different interest level rates, and many clients have the tendency to approach the bank that provides the cheapest interest in the first place. However, what we see is that many banks can also provide other factors, for example, some flexibility options. If it's possible for you to repay your loan earlier, or if it's possible basically to pause your payment schedule for 3 or 6 months because maybe due to Corona you're experiencing difficulties to pay. This is something where we see that clients have an additional willingness to pay, and this is something that is also reflected through the platform offer from the intermediary. However, it's something that you can use to justify a higher price. And that is also something that you should consider when setting up prices for the intermediary platform.
Okay, so then I would maybe move to the third section, because actually we presented today, I would say, some elements of our menu, but I guess the pricing optimization programs are a bit more complex anymore. And question to Julian, I would say, what are, let's say, usually the major components, and what is actually the effect of these measures?
Indeed, what we want to show is there are, let's call them two main dimensions. The one is the one described on page number 20 on the lower side of the slide. These are pricing methods for projects that we use to establish a sales and technical framework in order for our clients to be able to basically effectively enforce prices. This could be loyalty pricing initiatives where you basically set prices, mostly for private clients, according to product usage they have, so that they know, for example, if I use current accounts, credit cards, if I have a depot, or I use some brokerage facilities, I will receive a certain discount at any other product that I use. These are schemes that help a lot, especially for retail clients, to increase the share of wallet and to also justify higher prices for clients who do not have a strong relationship with the bank. This can lead, especially via cross-selling, to better profits and top line increase of up to 25%. And on the other hand, we're dealing with price leakage concepts, not only for cash and settlement services, but for all the products and services that are available within the bank. And like a concept that we discussed in the first case study, can lead to top line increases of up to 30%. But we are also talking about, as we did in the second case study, about targeted optimization of individual product modules, for example, private mortgage financing, or also corporate loans, also credit lines for corporate clients, where we usually are able to experience top line increases of somewhere between 10 and up to 30 basis points. And on the other hand, this is the same case for optimization of prices and products for cash and settlement services, private banking or wealth management and brokerage fees, also current accounts and deposits, where we are currently facing the zero or negative interest environment. And we are also talking to clients about, let's say, at least in Germany, where banks have to pay minus 0.5% on the deposits that the client has in the bank, to forward those negative deposit rates to clients, in the sense that if you had, let's say, as a wealthy client, 100,000 euros on your bank account, you would need to pay for this money to be on the bank account instead of receiving interest rate. This is current, let's say, best or normal practice in Germany now. Many wealthy clients need to pay in order to have liquidity on their account. And that is the portfolio that we're offering at ZDB. It's very conclusive in the sense that we are considering, let's say, groundworks and setting up the technical infrastructure, but we are also looking at the level of individual products, how to basically improve the top line together with our clients.
Many of you probably also ask, okay, is it a long exercise? Takes ages. Marek, maybe we could elaborate a bit on our approach towards a typical project. What were the key phases and how long it takes to complete it?
Yes, actually, the most challenging is the first phase when we actually need to gather the proper data and create a proper database. So we know that in the banks, some banks are more advanced or less advanced in terms of the data quality and in the, let's say, transparency on data. But typically, the approach is that even several weeks before we start, typically 4 weeks before we start, we send the data set that we believe is required in order to run such exercise. And in that respect, then we could have a jump start into the project. But typically, the first phase lasts 3 to 4 weeks. No? Then we also review the current approach, current processes, and so on. Then we do the market analysis, and obviously, we are building the database. And then we move into the design phase, where we actually start to design the tools. And we already have the indication of the target pricing that we'd like to have for different products, both fee-based and or interest-based, so that all in all, 2.5 months, 3 months, we'll be able to actually finalize all the tools and concepts and database, so that we could start to run the pilot. One region, we select one region or certain area, certain segment, and then based on the pilot results, then we create the scripts. We actually finalize creation the scripts based on the live results from the pilot, and then we basically have the full set of the activity in order to roll it out in the, let's say, on the countryside.
So summarizing, I would say this first 2 phases is roughly 2.5, 3 months, and then I would say depending, of course, on the on the product and the approach. I mean, we will go to the go live phase, where we basically create the migration concept, approach the clients, etc.
Worth mentioning that during this pilot phase, we are already doing this, let's say, live testing. Because before, even especially when we talk about the tools and solutions that are available for the relationship managers, then this, let's say, quality assurance through the testing of the tools already happens in the pilot phase.
Okay, good. I think we are slowly running out of time, but I mean, if there are any questions, I think this is the right moment to ask them. If I don't see any, I mean, gentlemen, thank you very much, Julian, Marek, for
participants as well,
for sharing your knowledge with us today. Thank you to the participants for joining us actually during the holiday period, but we are very happy that so many managed to join us. Of course, within this 1 hour, we managed only to present only a small, I would say, fraction of our experiences, but we are happy to continue this discussion on the bilateral basis. So if this topic raised some interest on your side, you would like to elaborate this in more detail and would like to see our opinion on that topic, do not hesitate to contact me or the colleagues, and we would be more than happy to discuss with you individually the approach. Once again, thank you very much for today, and let's hopefully stay in touch. Thank you very much, and have a nice day and goodbye.
Thank you.
Thanks. Bye.